Good morning, afternoon, evening, ladies and gentlemen, whenever you're watching this. So, there's been a lot of talk in the market lately about bond yields and how that is driving equities down, what is happening in commodities market, and different channels are talking about this, but invariably there's a lot of financial jargon and it becomes difficult to understand. In today's video, the idea will be to simplify this to the maximum extent possible so that absolutely anybody can make sense of it. And more importantly, what does this mean for us in equity markets or commodity markets? So we're just going to quickly go over that. To start, we're going to start with what are bonds. This is the textbook definition of what bonds are. But to put it quite simply, a bond is nothing but an agreement and a guarantee given by one institution, which is, let's say, me, the borrower, to another person who is the lender, saying, you give me this much money, let's say 1,000 rupees, and I will pay you interest, let's say 5%, 6%, over the period of 1 year, and for a period of 1, 2, 3, 4, 10 years, whatever is the tenure. That is what a bond is. Now, this is generally done by institutions such as governments or companies to raise money in the form of debt. Very simple. There is a borrower, there is a lender, there's an agreed period for which the money will be kept, and there's an agreed interest rate. Now, let us quickly just take a look at some of the government bonds. What is the sequence based on which interest is decided is generally how reliable somebody is and also how reliable their currency is. Let us say I'm a very reliable country and I'm not printing too much money and there's not going to be much inflation, so there's no currency risk. Then I will ask for a lower interest rate. I will say I will pay only less money because I'm very reliable. Let us say I'm a very unreliable country. I might be printing too much money. I might be bad with my fiscal or monetary policy, or generally I might not have the assets to pay back eventually the money that I borrowed. Then I will have to pay a higher interest rate because the perceived risk on the other side will be more. Very simple between you and me. If somebody has a very high credit score, they will get lower rates of interest. If somebody has a very low credit score, they will get higher rates of interest. So, of course, in governments, it's not just that simple. It also has to account for inflation and other monetary fiscal policies. But let us now take a look at some of the bonds. Currently, the India 10-year bond, if you were to purchase it today from the bond market, and we will get to that, will give you a 6.232% return per year over the period of 10 years. Australia, the same situation, it would give you a 1.7% return. Why is this? Is India far more unreliable than Australia? Not necessarily. The idea is there will be more inflation in India, so the rupee will depreciate against other currencies more, right? So that is how this fundamentally works. Now, first question somebody would ask at this point is, if RBI is giving 1 unit of bond for 1,000 rupees and saying they will pay, let us say, 6% interest, why is the yield changing? So we will go to yields now. Basically, when, let us say I am RBI, I'm taking 1,000 rupees and I am giving you a bond saying that on this 1,000 rupees, which I will keep for the period of 10 years, I will pay you, let's say, 6% interest. That will be 60 rupees. This is fixed. This will not change. The face value, which will be the 1,000 rupees, and the coupon rate, which is 6%, will be fixed. But there are other markets called bond markets, where between the person who has given me this money, essentially bought the bond, he can continue to sell it to someone else, or he can buy other bonds. So what happens? Whenever the price of the bond changes, let us say suddenly, fearing inflation in the Indian rupee, I start selling the bonds that I am holding. What will happen is the price will come down. In any market, the logic of demand, supply, and urgency remains the same. If I feel inflation is going to go up and I start dumping Indian bonds, and to find, I have basically the supply that I'm providing. To find the demand for that supply, I might have to dip below. What does this mean? The price of the bond might go to 999, 995, 990 because I'm trying to get rid of it as quickly as possible. That in turn, somebody is buying for 990 rupees but the interest that they will be getting paid from RBI still remains 60 rupees. So now the interest that they're getting paid is more than 6%. This is the same logic in a bond yield. If you can purchase the bond for less than its face value, your effective return is going to be more than the coupon rate or the interest rate at which it was issued. Similarly, if the bond price goes up, let us say suddenly there is a lot of demand for bonds, people are buying, so urgency is with the buyers, right? They are willing to pay slightly more. The bond price will go up, but the effective return, let us say you have paid 1010 rupees for a face value bond of 10, then the effective return will be less than 6%. Think of it this way, if you're earning 60 rupees on 990, you're earning more than 6%. If you're earning 60 rupees on 1010, then you're earning less than 6%. Very simple. Now, what exactly does this mean for commodities, equities, and bonds? Basically, commodities going up is what can be associated to inflation. If commodity prices goes up, then raw material prices go up. And if raw material prices go up, businesses will suffer because they have to pay more for raw materials. Very simple. What is the other aspect to this? If the price of fixed instruments goes up, let us say people are dumping bonds. That means price of bonds is going down. They become attractive because they are giving more returns. To put this very simply, let us say FDs are giving higher returns. More people will opt into FDs. Why will they come and take risk in equity markets? Risk assets become less attractive the better the gains fixed assets give. Very simply, if FDs were giving 15% return, we would park a lot of our money in FDs rather than taking risk with it in equity markets. Everything is relative. There is always a balance between fixed instruments and risk instruments. And right now, since markets are forward-looking instruments, which means markets will always try to think about what will be the rate 6 months from now, 1 year from now, they believe that since the trend is upwards and the trend might continue to go upwards, people are getting scared of equities. Very simple. What is the second reason why equity markets panic when bond yields go up? It's because for institutions, similarly like you and I, if fixed instruments, the opportunity cost is not very high because fixed instruments are giving good returns, then money flow will go into fixed instruments. So how does it affect equities? Mainly two things. One, cost of raw material will go up. Two, cost of borrowing also will go up. All businesses need to borrow money in order to run their business, unless you're able to do it purely with cash flow. And if basically bond yields go up, you will have to pay more interest to borrow that money. So at that point, your margins will come down, your profitability will come down. So what all are you suffering from? You're suffering from paying more for your raw materials. You're suffering from paying more interest rate, right? And your stock is also suffering because other people find fixed instruments more attractive. This is as simply as it can be put. And what does this mean from an outlook of an investor or a trader? So first, as an investor, what is going to happen next? Simplest answer to that is absolutely nobody knows. Bond yields might continue to go up, they might stabilize, they might come back down. Nobody knows. But right now, there is a certain fear in the market due to which we are seeing considerable corrections, especially in growth-driven stocks. What you should do is continue your allocation through SIPs. Don't enter at a lump sum. Don't exit at a lump sum. Continue your allocations. Have a good amount of exposure to commodities as well as commodity related stocks. So you can look at gold, silver, crude, steel. If you're not directly invested in commodities, have some allocation to companies that deal in commodities, right? That gives you that diversification. And similarly, continue to do what you're doing. Don't try to time the market. Don't try to change your approach because of a little bit of noise that is happening here and there. And as long as you have enough diversification you can even have currency diversification by holding equities of different countries or having commodities, your portfolio will continue to perform well. And in the longer term, we continue to remain in a bull market for now is how a majority of analysts would look at it. So to conclude, more or less, we've gone over what are bonds. Nothing but an instrument where one person is guaranteeing to pay somebody else interest on the money that they've taken and return the money after a period of time. What are bond yields? Basically, since these bonds can be traded in a market, their price variation is inverse to the return that they will generate. If the bond price goes down, yield will increase. If the bond price goes up, yield will decrease. And finally, what should you do? If you're an investor, be diversified, have commodity exposure. And if you're a trader, just know that there will be a lot of volatility in the market. So plan your trades accordingly. Volatility can be a great thing for trading. And at the same time, manage your risk appropriately. So this is something new that we tried, a short video about something that is hot in the market right now. If you want further videos like this, do let us know, give us your feedback so we can bring you these and make it better for you as well. Thank you so much for watching. Have a great evening.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.